All right, now to our next conversation. African local currency bonds have shown more resilience than emerging market peers as domestic investors held forth significantly. The AFMI Bloomberg African Index has gained 0.7% year to date, outperforming the negative 5.2% pullback in the JP Morgan GBI Emerging Market Core Index. Well, we have Baboye Olaolu, economist at Cardinal Stone. Great to have you on the program.
Thank you so much.
Yeah, so the African local bond, has outperformed emerging market peers. What do you think influenced this run?
Okay, so just to put a bit of context to it, like you rightly mentioned, the African bond, the local bond has largely outperformed the emerging markets, right? The reason for this sharp decline that we saw in the emerging market bond is due to elevated capital reversals, that we're seeing from emerging markets due to tight global monetary conditions and as well as rising yields in developed markets. But for the domestic markets, in the African space, the story has been a little bit different. We saw that domestic guys continue to hold the market because they hold about 65 to 70% of the entire fixed income market holdings, right? The impact of this has relatively supported the positive performance that we've seen over the last few months.
Quite interesting, but we're seeing foreign outflows from emerging markets has intensified, in recent months. But the trend is it likely to change? How long can locals actually continue to hold the fort in the domestic bond market?
So it's difficult to tell when we'll see investors return back into the market. But when we check the numbers, firstly, we saw that the global value of negative yielding bonds, which is a very key indicator to the disposition of investors in the past. We saw that the bond, the value as a percentage of the total outstanding global government bond has declined to about 4.5% as at the end of last quarter. When you compare it to 50%, in mid-2019, around August, this just gives an indication to the fact that the rising yields, has wiped out some of this negative yielding bond. Secondly, the prognosis is for yields to remain, to continue to tick upward, right? Because investors are expecting, tight monetary policy, a disposition from global central bankers, right? Like we've seen from Fed has increased the rates this year by about 250 basis points. And when we check the Fed probability index, the market is already expecting or pricing in about 3 to 4 rate hikes, coupled with the one that was done some weeks back. So this just tells the story that foreign flows will likely remain risk averse of the domestic market. And in terms of how long can the domestic guys hold the market, like we rightly said, the domestic investors hold about 65% to 70% of the entire market holding. We think that they will continue to hold the market, but the duration play for them is likely short end of the curve, because of the expectations that yields will continue to rise across the market. When we check the Nigerian market, for instance, our expectation for hawkish monetary policy, elevated fiscal borrowings, all support the prognosis for short-end play. When you go to Angola, there is election risks there, and then there is also elevated borrowings from the government. We've also seen some governments like Ghana are coming up with subsidy, just to pushing the impact of elevated commodity prices on consumer index. All this will require fiscal spending, which might seem part of the fiscal needs, coming into the domestic market. And you might see domestic investors asking for higher yields. Hence, we think that we might be seeing more short duration play over the next few quarters.
Right, all eyes on global rate hikes. But, away from the trend, in the African region, what has been the story for Nigeria's fixed income market?
So for Nigeria, yields has trended downwards since the start of the year. We've seen very bullish sentiment. This has largely been driven by the elevated liquidity, in the market. You will recall the liquidity that we had in Q1, right, was about 43% of the entire liquidity that we're expecting in 2022 from bond maturities, bond coupon payments, FAC inflows. All this supported, the liquidity, which also fueled the bullish sentiment that we saw. Aside from this, the exemption of government bond, from tax also found an additional bullish sentiment in the market. right? And that has been the trend. But for the short end of the curve, which is the NTBs market, we've seen that investors, have remained largely risk off, from the market. And in fact, we've seen some investors rotating out of the NTBs market into placement and corporate papers. And when we check the numbers, we saw that corporate papers and placements are currently trading at 3 to 5% premium, over the NTBs markets.
All right, so it's a new quarter. What should we expect for Nigeria's fixed income market?
So we think that the question is, has fixed income yet to bottom yet? Right? One of the dynamics that we saw that drove the market reaction in Q1, part of it will change in Q2. For instance, the elevated liquidity that we had in Q1 will likely change in Q2, right? Because of lower maturities. Secondly, the elevated fiscal deficit, right, is likely to be more pronounced from Q2. In fact, when we check the bond auction calendar, we saw that the government's intended borrowings in the markets, right, is about 50% increase than what was offered to the markets in Q1. Right, this just explained that we might be seeing more aggressive borrowing from the government, liquidity thin out, and then markets also watching the disposition of the CBN. And hawkish rendition will signal to the market. So the prognosis, from Q2 is for yields to increase, and then we might see investors playing at the short end of the curve.
All right, but we'll keep watching and see how all of this plays out, because right now it's all about global rate hikes at the moment, trying to battle inflation there. Boboye Olaolu, economist at Cardinal, so it was great having you on the program. Thank you so much.
Thank you so much for that.